Thanks for tuning in to your daily dose of quick real estate updates, local housing trends, and market data, plus tips, tools, and strategies to help you buy, rent, or invest with confidence. You're now getting ready with RealiCare Reports, powered by the innovation team, Cami and Rex. Now go grab your favorite morning breakfast, coffee or tea, and let's enjoy today's episode.
Okay, so if you're trying to solve the whole inflation puzzle in the U.S. economy, the one piece that everyone keeps wrestling with is, it's shelter. It's the roof over your head.
You're spot on there.
Yeah.
Housing, or what the government calls shelter, it's the single biggest piece of the consumer price index, the CPI.
Which is why everyone's watching it so closely.
Everyone, from the Fed trying to figure out interest rates all the way to, you're just trying to figure out your own monthly budget. It's huge.
So for today's deep dive, we've got some fascinating new research. It's Zillow's latest CPI Shelter Forecast. We're looking at the numbers from September 2025 and, more importantly, what they see coming way out into 2026.
And our mission today is to solve this kind of riddle for you. Because Zillow's own market data is showing that apartment rents are actually getting cheaper, maybe even going negative.
But the official government numbers still show inflation.
Exactly. So we need to unpack why those two things, what you see on Zillow's website versus what the CPI reports, can look so completely different.
All right, let's just get the main takeaway right out on the table. The big headline here is that Zillow expects housing inflation in the CPI to slow down. And not just a little bit, but significantly, all the way through 2025 and into 2026.
And the reason for that is that the slowdown has already happened in the real-time rental market. The official government numbers are, well, they're just playing catch-up.
And that forecasted slowdown is really the key to the whole economic outlook, isn't it?
It's the linchpin. If shelter costs come down like Zillow thinks they will, that's a huge counterweight to prices going up in, say, gas or food.
Yeah.
If you win the fight on housing, the whole inflation battle just looks a lot more manageable.
Before we jump into the numbers, we have to clarify what the CPI is even measuring. It's not just one thing called housing. There are two main pillars here, right?
Exactly. The shelter component is built on two primary measures. First, you've got owner's equivalent rent, OER for short.
Okay, and OER always feels a little bit theoretical to me. How do you explain that in simple terms?
Think of it like this. The government surveys homeowners and asks a hypothetical question. If you were to rent out your own home today, what do you think you could get for it?
So it's not real money changing hands.
Not at all. It's the implicit rent. But it's designed to measure the cost of housing for people who own their homes. And since it covers something like 2/3 of the housing stock in the index, its movement is, well, it's enormously important.
And the second pillar is a lot more direct.
Much more. That's the rent of primary residence. This tracks what actual tenants are really paying in rent. It's based on surveys that capture changes when leases are renewed or when new tenants move in.
Okay, so with that background, let's look at the actual data that came out. This was October 24th, reflecting the September numbers. And the headline was, well, it was a sharp slowing.
A very sharp slowing. It was the lowest rate of housing inflation growth we've seen since 2021.
That's a huge deal. Almost 4 years since it's been this slow.
It is a big milestone, and it definitely supports the overall trend. But when you dig into the specifics, you see just how noisy the data can still be.
Let's start with OER, that owner's equivalent rent. The seasonally adjusted number for September came in at just a 0.13% increase.
Yeah, and that was a huge miss compared to the forecast. Zillow was expecting something like 0.32%. So it came in at less than half of what they thought.
And what about the year-over-year number? That's what really matters for the big inflation picture.
Right. Year over year, OER is now up 3.8% from September 2024. And that is, without a doubt, the slowest annual increase since way back in November of 2021.
So does Zillow see this as proof that the Fed's rate hikes are finally hitting the housing market hard, or is it something else?
They're a bit cautious. They called it an abrupt decline, but they also noted it came right after a month of, quote, unexplained heat.
So the data is still bouncing around.
It is. It tells you not to overreact to any single month, whether it's high or low. But the underlying trend is what's important. And that is a gradual, persistent slowdown.
How so?
Well, if you average out the last 3 months, the monthly increase in OER was 0.26%. The 3 months before that, it was 0.31%. So you see, the trend is gently but clearly pointing down.
Got it. Now let's switch to the other side of this. What about people actually paying rent, the rent of primary residence?
That one was much more in line with expectations. It rose 0.20% in September. Zillow had penciled in 0.24%, so very close.
And annually?
Annually, that's up 3.4%. So again, both pieces are slowing down, which really sets the stage for the forecast going forward.
Right. So if the trend is down, let's look ahead. Zillow is calling for a pretty dramatic downshift all the way into 2026. This is where the real relief is supposed to show up.
It really is. Starting with OER, Zillow thinks it'll end 2025 up about 3.5% for the year. And what's interesting is they've already revised that down. Just back in August, they were thinking 4.0%.
So they're getting more optimistic about the slowdown. And what about 2026?
For 2026, they're forecasting a huge drop to just a 2.2% annual increase. That's cutting the current rate almost in half.
Wow. Okay, now for the rent of primary residence, the actual rent payments.
They see that ending 2025 up 3.0% year over year. And again, that's been revised down from 3.5% back in August.
And the 2026 number?
That's where it gets even sharper. They're projecting a slowdown to just a 1.7% annual increase. If that actually happens, it would be a monumental amount of relief, both for renters and for the overall inflation picture.
Okay, but this is where my head starts to spin. Zillow is predicting relief in these official numbers, sure. But then you compare it to what's happening on the ground with the rental listings you actually see on their website. The difference is just staggering.
This is the absolute key to understanding the whole thing, the disconnect. Zillow's forecast for what they call on-market rents, so the price of a new lease you'd sign today, is wildly different from those CPI numbers we just talked about.
Okay, give us those numbers. What about single-family houses?
For single-family home rentals, they see growth slowing to 2.8% in 2025 and then down to 2.0% in 2026. So, a steady, gradual cooling.
But the apartment forecast is the real bombshell.
It is. They expect apartment rent growth to slow to just 1.1% in 2025. And then for 2026, Zillow is forecasting that apartment rent growth will fall to negative 0.3%.
Wait, say that again? Negative?
Negative 0.3%. That's not just slowing inflation, that's deflation. Outright price drops for new apartment leases.
Hold on. How is that possible? If new apartment leases are actually getting cheaper, how can the government's rent of primary residence number still show a 1.7% increase in that same year? The math doesn't seem to add up.
That is the core of the lag effect, the perfect illustration. Think of the CPI data like a giant cruise ship.
Okay.
Zillow's on-market data is like a little speedboat zipping around it. The speedboat can turn on a dime. The cruise ship, it takes miles and miles and a lot of time to change course.
So the CPI is the cruise ship.
Exactly. It's full of millions of existing long-term leases. So even if the price of a new lease today is negative 0.3%, the CPI survey is still capturing someone who signed a cheap lease 2 years ago and is now renewing it at a price that's maybe 5 or 6% higher than their old rent.
Right. So that backlog of old, cheaper leases that are now resetting higher, that keeps the overall average, the official number, propped up for a long time.
For a very long time. The CPI doesn't just track new leases. It's heavily weighted by what happens at renewal for all the tenants who stay put.
But if the market is really dropping, why would landlords keep renewal hikes so high? I mean, doesn't that new lower market price eventually drag those renewal rates down with it? Is it possible that 1.7% CPI forecast is even too high?
That is the million-dollar question. Zillow's model builds in a certain amount of, let's call it stickiness. Landlords are often slow to offer lower renewal rates, even if a new tenant could get a better deal. They're counting on the fact that moving is a huge hassle.
So they bet you'll pay a little extra just to avoid packing boxes.
Precisely. But you're right. If the market correction gets even deeper, that 1.7% forecast could absolutely come down even faster.
And I assume Zillow's model for this isn't just guesswork. They're connecting their own data to these government indexes somehow.
They are, yeah. It's a formal model that links their Zillow Observed Rent Index, they call it ZURI, directly to the CPI's shelter components.
So what goes into that model? What are the key variables they're looking at?
It's basically three things. First is their forecast for on-market rent growth. That's called ZRF, the Zillow Observed Rent Forecast. That's their crystal ball for new leases.
Okay.
Second, they make assumptions about how landlords handle renewals, that stickiness factor we just talked about.
Yeah.
And third,
What's the third?
renter mobility rates. Basically, what percentage of people actually move each year and have to face the new market price versus how many stay put and just face a renewal increase. If more people move, the CPI catches up to reality much faster.
Okay, so let's put it all together. The big picture is that the real change, the thing that's going to drive the official inflation numbers down, it's already happening. We can see it right now in the on-market data.
That's the key takeaway. It just takes a very long time, months, maybe even a couple of years, for that deceleration to fully work its way through the system and show up in the official stats like OER and rent to primary residence.
The peak of shelter inflation is long gone. The forecast is pointing to continued relief, with those big annual CPI growth numbers potentially getting cut in half by 2026. So relief is on the way. It's moving on government time.
Exactly.
And that leaves us with a final provocative thought for you to chew on. You've heard the forecast. Apartment rent growth in 2026 is projected to be negative 0.3%. So what are the real implications of negative rent growth for affordability, especially in those big, expensive cities? And maybe more importantly, what does this do to the business model of major landlords, who for years have relied on those sticky, ever-increasing tenant renewals? When you go from massive gains to a slight contraction, well, that's a monumental shift for that entire industry.
Well, that wraps up today's episode of Reality Reports, where real estate meets real life. For more updates, tools, and insights that will help you buy, rent, or invest with confidence, be sure to follow, subscribe, stay connected, stay informed, and stay ready. Until next time.